It's time for Macro Monday, where the city's heartbeat meets the global economy. From Wall Street to the West Side, we track future interest rate moves, credit spreads, and national market shifts that shape New York City real estate. Fast, focused, and data-driven. Macro Monday starts now.
I don't know, man. That's fun.
What do you mean you don't know?
That is something.
Oh, come on.
Something.
That's something. Guys, we need help. We're not
Yes, we do. Yes, we do.
Guys, John needs help over here.
I do need help. Look, I live under a rock. I tend to avoid anything that's like self-promotional. So when I see something like that, I'm like, oh my God.
Well,
help me.
We need to hear from you, 20 some odd people. I mean, we knew it's going to be a light week, so a perfect week to push something like that live. I need to hear some comments, guys. Carol, I hear you, Carol. We're always open for comments, even if it's really, really bad commentary. We could take it. We're real estate agents at the core. But I would love to know what you guys thought of our intro video for Macro Monday, and give us feedback if you can, because we're trying to make it cool and make it fun. And this show is supposed to be fun. So put it right there in the comments. Let me know what you think. But what?
It is fun. I like this show is a lot of fun. This is why we do it. Really. I mean.
Why else did the 30 people come on?
I haven't seen Ed McMahon show up at my door with a giant check saying, man, you guys, this is it. But it's fun. It's a fun show, so we do it.
We're speechless.
Yeah, so am I.
It's not beating fun. All right. Well, we're just having fun, guys. So I thought it was a good time. Yeah, let's get to it, guys. That is John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs, and today is Monday, so you guys are going to get a little macro. I'm sorry. Carol says how many people just left. I don't know, Carol. We're not tracking that. We'll figure it out. All right, let's get back to the intro. It is Monday, so you guys are going to get a little Macro Monday coming right at you. For those of you that are new to this show, we're going to start out with Manhattan real estate over here, tell you what's going on. Then we're going to go to some macro topics. I got a couple things on. We're not going to make it too heavy because we got turkey and gravy and tryptophan.
Pre-parade edition.
Pre-turkey, pre-gobble-gobble, Macro Monday. So we're not going to make it too heavy. And then we'll come back to Manhattan real estate. We'll try to do this in 30 minutes or less. And nothing that we talk about today is financial advice. Nope. Okay? Don't start day trading. Okay. Guys, I am on the market snapshot. I am on the 1 month ticker. I see supply 986. Everything's going down. 'Tis the season. We warned you about this. So we're now starting to see it. Liquidity is really going down. But let's start with supply, Johnny. 986, down about 37%. And from my notes right over here, supply is supposed to end November at 991 is our average for supply for November. Mm-hmm. We're pacing at 986. So the question is, over the next week and a half, are we going to get so much stuff coming on the market to push this higher, or are we going to go lower? In which case we have, again, a light month in terms of supply.
Well, I mean, it's a good question. So supply, the pace of supply is obviously going to drop off. Like this week is going to be really quiet in terms of new supply. At the same time, you do have some deals that are in the pipeline that are coming through, which is going to remove some of the actives, put them into the contract sign bucket. So net, we might see negative supply this week or off market. Yeah. So the question is, how much of that negative draft are we going to see? I don't know. We'll see if we can get back to
I don't know whether
seasonality or up ahead.
Yeah. It's going to be light. You might see this drop down a little more, right? And you got some big bars. Like, see these big bars, guys? This is the moving average. Okay. Boop, boop, boop. Moving average. Today's information, today's new listing count that comes in, that gets counted into this tomorrow. And day 30 of this moving window goes out. So like there's some big bars that are going to go out in October to end November. So this is going to go down. I wouldn't be surprised if we're in the 800s by the time it's all said and done. Yeah. Contract sign activity, 30 days, 884. Check my notes. That's supposed to be at 850. We're slightly above, but we had a big move down, guys. Remember, this is a 30-day ticker. Mondays are the worst day to look at this. Monday is a low day because you're just coming after a weekend, right? You could see it right here. You can see weekends over here, weekends, and you got weekends over there. So this is a low day for liquidity. But this tells me that you probably had some big bars. Just like we talked about here, you probably had some big bars at the end over here that got faded out. So now a little bit's coming in and a lot's going out. That's how this moves down like that.
That's how it works. Do you have an update on Brooklyn, Noah?
I
don't know if we have notes on Brooklyn. I haven't.
Well,
attention.
I got Brooklyn, but I don't know the averages offhand. But we have Brooklyn. You can go to 1 month over here. It's gonna have to load this whole thing up right over here. Let's go to 1 there.
You can see the trend. You can see the liquidity chart. This is one of the things we were talking about on the Friday episode, is why the Brooklyn market is actually seeing an uptick in activity, which is interesting. I mean, it's starting to come alive. As I was joking, it's like a Harry Potter reference, the golden snitch. Like it opens at the close. So here we are. Got a week left before people take it easy, and Brooklyn's like, let's go. So
let's go. That holds Brooklyn up. Does that. Brooklyn does that. It does its own thing. It's doing slow. Manhattan's doing good. Manhattan slows down. Brooklyn picks up. It's like, pick a trend. Follow it.
Brooklyn sets trends, man. They don't follow trends. I mean, we know this. Yeah. Trend setting.
Totally. We got a good question here from Carol. Do you think off market is more temporary because of holidays? It will come back on in a few months or weeks. Yes, I do. Yes, I do. 'Tis the season. This is our seasonality over here, guys. If we go to the chart room, checking out optimal time to list in our chart room, right? That is contract activity. It'll show you that December and January are the 2 down months. You see the same trend in new listing activity. You see the same trend in new listing. It goes down. So it's just doing seasonal things. Okay.
Well, I think in general, there's 2 components to off, with a few components to off market. One is seasonality, right? You don't want to be on the market when there are no buyers around. So a lot of people take those off. Sometimes there's a failure mindset, which is like, we've been on the market for, 8 months. It's not happening. Let's pull it. Let's think about it. And then the third one, which to us is really the more serious one, is there's a fundamental problem with the market, and I don't want to have anything to do with it. So I'm going to pull this listing. And that's one of the things you saw in 2008. One of the things you saw right before COVID. You saw these huge spikes in off markets as people were just pulling their listings out because they didn't want to participate in a market that they thought was either going to collapse or do something funky. So they're overpriced and they're unrealistic. Misunderstood bucket. Yeah.
Yeah, because it doesn't tell the why, right? It doesn't tell you what's going on. It doesn't tell you why. It's just, have to speculate. It just tells you the aggregate numbers. But yeah, there's a lot of people that are overpriced right now. There's a lot of properties that are still getting penalized, unrenovated properties getting penalized, properties with weird things that are going on in that property that are getting penalized right now, high carry, stuff like that. It's just, they're going to go off market, most likely, unless they have to sell. So this is where the rubber meets the road. And you're going to find out who has to sell and who doesn't. Because if they stay on through the holidays and in December and January, they got to sell this thing. They got to liquidate. So, okay. Good. No more questions? Good. Let's move on. Macro, credit spreads, guys. 60 seconds or less. John and I promised ourselves on this. Credit spreads are elevated from a 6-month perspective. You take a look at credit spreads right here. They're a little elevated right there because it was higher over there 6 months ago. But if I zoom out 1 year, this was that little tariff thing right there that we had in April. That's what kind of stopped our market. Yeah, exactly. And I should just go away. But we're up, John, but we're not like that. So it's like,
it is. So, look, if you look at the peak, which was Liberation Day, and you kind of go down all the way to like a couple weeks ago, that down move, that long trend down move or medium term trend down move, whatever you want to call it, was really like a giant signal for risk on, go, go, go. We've essentially kind of broken that trend. We're sort of going sideline, and I think you're noticing that too in the equity markets, which is a little bit less frothy, a little bit more. All right, well, let's take a day at a time kind of here. Especially when you look at some of the crypto action that's been happening; those have been completely just hobbled. So it's a little bit of a mixed bag here when it comes to these. There's no canary in the coal mine here, but it's a little bit more on the cautionary tale for, risk versus reward.
Yeah, the credit markets are reminding people to keep an eye on the credit markets. That's like what's kind of going on right over there. But there's no crazy market signal. If this starts going up to 2.2 and 2.3 over here, this little indicator, we might have to start worrying about something, but we'll keep an eye on that. Rates. Look at that, Johnny. Look at that change.
We are back in cut territory once again. And this, I think, is all credit to the New York chair, John Williams, who basically said, "Well, I could see possibly a rate cut." And so the market took that and they ran with it. Everything kind of shifted to the left. What does that do in the end for rates? Kind of helps bring that 10-year yield down, which pulls the 30-year down. So as things shift, these boxes move over to the left, even though we don't like to look at them. We don't like to look at them. We don't like to say this is where rates are going to be. It's more that sentiment kind of shifted to the left. That's going to influence rates, hopefully to the downside. Who knows? Who knows? Maybe there's a little bit more stuffing left in this turkey.
Well, let's go over this table for those of you that are new to this or just joining the show. This is future meeting dates of the Federal Reserve. These are all future dates right over there. It goes all the way out to 2027. You are not to do that. Don't go further out than maybe a couple of meetings. Let's just X all this out. This is how far you want to go out. Okay, this is too far away. All that kind of stuff could change. We are here. And yeah, this was blue last week. And it's going back and forth and back and forth. That's what's going on, guys. This is going back and forth. As time goes on, these numbers will solidify itself. So now you got that cut back on the table, which means mortgage rates must have went down. Last week, it was opposite. Last week, this went from here to here, and we're like, mortgage rates are going up. Now it went from here.
And there was a huge spike in the jumbos last week, right? So the conforming rate's a little bit more staid, a little bit more conservative. It's that jumbo rate. These are held on the portfolios. They're held usually for duration. So you get that big spike up. It's kind of worked its way back down. Conforming is off its lows, certainly, but it's more sideways action. So hopefully we get a little bit more back that downtrend. Let's see.
Yeah, that light blue, as John says, that's jumbos, guys. You see that little up move right there? That was last week when they said no cut. And now it changed. So now there's a cut. So this is why we don't pin reputations on this kind of stuff. This is why we're reading the tape as much as we can. This is why when these numbers go higher, our confidence goes higher. When the numbers are 50-50 coin flip territory or below, we stay away from it and just acknowledge it and just discuss the information. Tell clients we're aware of it in case they ask us what's going on, right? We know what's going on. 77% chance of a cut in December. Go ahead, John.
I'm thinking out. I'm going to be thinking out loud here. So I haven't quite processed these thoughts, but I'll just tell you what I'm thinking. Typically, the market really loves the shift and the transitions, and they love it because they have an idea of the direction of the market for the next period of months, years, etc. A lot of times that's we're heading into a rate reduction cycle, a rate increase cycle, whatever it is, but you know that, all right, it's the beginning of the cycle, so we've got some going on. When you look at these rates, Noah, right, we've got one cut right now penciled in for December, maybe another one, what is that, second quarter, first quarter of 26?
April.
And there's a couple more. This is not, I wouldn't say this is a rate reduction cycle. I would say that this is a very plain Jane sort of middle of the road thing here. I don't think you can really look at this and say, all right, well, we're anticipating rates to be really low in a year, 2 years from now as we kind of get rid of all these high rates and move on to something lower. No, I think we're very much, middle of the road territory. And you think about some of the equity valuations are already pricing a lot of this in. So I think that kind of, again, feeds back to our credit spreads and kind of sees them pick up a little bit of uncertainty there, a little bit of idea that we may see a little bit of easing on these rates. However, we may be close to the neutral rate.
I think I know what you're saying. Could I? Because
that's good. At least one of us does.
Well, I knocked my head yesterday, so I'm thinking a little off right now, but I did. Let me try to explain what I think you just said in case you don't understand what John just said. First off, we're here. That's where we are. What John's saying is that there's a period of normalization cuts that don't necessarily are being made because the economy is in recession. So let's call them normalization cuts. And let's just say that the normalization cuts are 2 or 3. So that's the window of normalization cuts. Then you got your, we're in a recession, we're going to go down to here kind of cuts, right? That's recession cuts. And I think what John's saying is the market is starting to kind of just get into this neutral. It's just cutting to get to the neutral rate, which means they're not cutting because of a recession and slowdown, which means this cycle is going to be short. Is that what you said?
That's kind of what I'm saying. Well, and the interesting thing is, while I don't think this is going to be absolutely phenomenal for equities, like you could definitely see you can see a continued bifurcation. You can see the AI and the techs, the Mag 7s keep going up based on growth estimates. The consumer staples are kind of in a sort of cyclical sort of the treading water. I do think this is actually pretty good for real estate because I think the longer you get into a more normal rate regime, the more of it acts as sort of a transmission mechanism for like, okay, it's a decent time to buy. And we've already seen that in the luxury sector, right? That message like, oh, okay, I can buy in New York. We've seen that pass through. And this market is, I mean, it's basically kind of the same as it was last year. I mean, some prices up, some prices down. But in general, that thought that like, okay, maybe I do want to buy in New York is making its way through that luxury market and hopefully into the non-luxury market because rates are sort of stable and the market's holding its own. So I think that's net a very good thing.
Roberto's asking, what would you consider the neutral rate, Johnny? If we're up here, what's neutral?
I would think another half a point down would be probably peak neutral.
Right
That's
about
two
there.
cuts,
So that
basically.
puts us right about there. Yeah.
Yeah.
Okay.
I think that's kind of to me where I see it. But I mean, they haven't hired me yet. No, I keep raising my hand. I'm standing on the corner of the Federal Reserve. And they just keep passing me by. So.
And I would say, Roberto, to answer that question from my perspective, I have no idea which box it is, but I'm going to give myself a wide girth here. If we're over here now, I'm putting the middle right about where Johnny says, but it could go a little bit that way. It could go a little bit that way. So somewhere in this range is what I think neutral is. But this is really
neutral. And if neutral gets rates down below 6% on the 30-year conforming, that could be key. That's really what I'm hoping for, because I don't want prices to go up, but I want transaction volume to go up. So I want that's our own sort of Federal Reserve conundrum, is like we want transaction volume, but stable prices. So
there's that thought about real estate super cycles, banking and super cycles, that 18 to 20 year cycle with housing, and that basically said that this is not the crash. This is not the crash in housing. It's gonna come back, and it's gonna go to 27, 28, 29. It's gonna come back. So whether or not that's gonna happen, we'll see. It's like the farmer's almanac. You just never know. Meanwhile, look at the right side here, guys. Look at the right side. This is a Goldman Sachs piece that came out recently. And I thought it was interesting. I don't want to get confused in interpreting this chart, but take a look at year-over-year core PCE inflation. I just want to show you one inflation element to summarize what's going on with the economy, right? Because it's a battle between inflation and jobs right now. And this is why the Fed probably can't cut too much, because look at the solid blue line. That is actual core PCE inflation. The target's down here at 2%. Can I draw over this? Yes, I can. Okay, so the target, that's target. Okay, guys. So we're above target. See this right here? Boop. See that? That's the line I'm talking about. We're above target. So you got two forecasts. You got the forecast with the tariffs, expectations, and how that's going to hit services and then goods. There's an argument that tariffs are hitting services, not goods. I would argue they're both combined. Goods are part of services, but whatever. So that may come through. And then there's an estimate without tariffs. It shows you how much that tariff element is really in the forecast, Johnny. It's a big gap before debates.
No, it is. And what's really interesting to me is that you look at that blue line, the actual, and it's the Fed's target is 2%, as you said, and we have been above that target considerably. I think we've had a couple months where it's been slightly below, but in general, like we've been pushing closer to 3 more than we've been pushing closer to 2. It's been really sticky. So the question is, how long can the Fed hold out at this neutral, whatever they consider to be a neutral rate? It's obviously not a 2% rate. It might not be a 5% rate, but it's where is it? We'll have to figure that out.
Remember that owner's equivalent rent chart that we talked about a couple of times here that showed the rents coming down? That is that's a 25% or something like that of CPI.
It's huge.
So that going down is a future indicator of the downward drag. So this is going to be an interesting thing. If I had to choose one way or the other, I would probably choose more on the disinflation element and more rate cuts. I guess if I had a bet on it, as of what I see now. So.
But it's a little worrisome to have. I mean, look, if you've got a lot of inflation pressure, right, which is what this chart shows, and you have the core PCE, you have the owner's equivalent rent sort of deflating things a little bit. Like if that turns around, inflation could whip up in terms of the numbers that the Fed sees. So it's a little strange to have all your eggs in one box in terms of inflation.
Yeah. Sentiment. If I had to, guys, let's go back to here's what you need to know. Let's go back to here for a second. What?
Back to rates. Can't get out of macro.
Just for a second. No, this is important. In case anyone asks you what, you got one cut that looks like it's going to happen that you're comfortable with. And it's inflation and jobs, guys. Inflation and jobs is why you don't want to predict too much of this, because as John said, inflation could poke its head and all this goes out. So just be careful. All right. Those are the 3 things you need to know. One cut in December, and inflation and jobs is the fight that the Fed has. Okay, good. There's jobs. There you go. I showed you inflation. Now there's jobs.
Right. Not a lot of jobs there.
No, the jobs market's a little cracky. Not cracky like crack cocaine, but like it's showing some cracks.
Yeah, and there have been some interesting pieces out over the weekend, I think, on Bloomberg, talking about the idea that there actually could be some jobs associated with AI that just have yet to materialize, I guess, as they build data centers. As the other talk about AI, which I think is actually really interesting, and I see actually some comments in here, in the idea is it's right now it's about building that AI, it's about building the capacity, but with most things, it's less about building it than about how it's applied and how it's used. And that's where the next phase of it is like, how are we using this? And I saw a question. I remember who asked. I saw the question in the chat. Like, are you using Gemini for valuations? I would probably say that's interesting. I'd obviously like you to reach out to us. We have a UrbanDigs advisor.
Oh, the Gemini, the chat, like the Chat GPT, the Gemini. Okay,
right.
Gotcha.
That's Google's version. But it's going to work its way into things, and people are going to be figuring out, well, how do I use AI for this? How do we use it for that? And that can obviously this is get the creative entrepreneurial juices flowing. You could have yet another sort of, run up in the economy as those jobs get attracted to that. And, AI gets rid of the hard work of the grunt work of data and, focuses on more higher skilled level stuff. So hopefully that's where we're going. But again, we're still in early stages.
This whole AI thing is crazy. Like this whole crypto right now, what's going on right now, like this whole crypto thing, this whole Michael Saylor and JP Morgan thing that's going on. I don't know if you guys are reading into this at all, but there's like a mini battle kind of going on between these two guys, and nobody knows which way it's going to go. It's like it could force one or the other with such a big market behind it. Yeah, I don't know. The only bubble I see in AI and the craziness I see what's going on, it reminds me of, again, the fiber optic phase of the .com boom kind of thing. But we'll see what happens. I don't know. Data center, AIs, I don't know. It's all crazy stuff. Okay, moving on. Just a quick thing about the national housing market, since this is a housing show and it's called Macro Monday. Share of U.S. mortgages with negative equity rate by loan type and vintage, guys. Look kind of at the left to all mortgages right over here. Look at that darker, well, I don't know what color that is. I'm bad in color palettes.
It's like green. I just call it green, like a dark green.
It's like a green. I guess it's like an ocean dark green kind of thing. That's 2025, guys. So like basically what's happening here is this: there's small foreclosures. Are they going up? Yes, but it's small. Share of mortgages with negative equity. That means you bought the house for $1 million and now the house is worth $950. That's what that means. So it's reflecting the fact that a lot of housing markets outside of our bubble have rolled over and are going down. And this has been something that's been going on for a couple of years. It's quite mature in its cycle, in my opinion.
Yeah, I just want to thank Keith for the definitive word, marine green.
Marine green.
Thank you, Keith.
You did say ocean. I said ocean green.
You did, but it's not quite ocean. It's more of a marine. So that's absolutely nailed it. So look, yeah, I think you're right. And I think what's deceptive about this chart, not that it's unhandy, but it is interesting because you think about that, it's a percentage-based chart. So the number of sales in 2025 is obviously lower compared to, I think, pre-2019, et cetera. So the number is obviously going to be spiking higher because you have a smaller data set to begin with. And so foreclosures are probably higher, or the negative equity is probably a little bit higher than 2025's comparatively, but because it's a smaller bucket, you have that bigger spike. But yeah, I mean, the housing market is essentially going sideline. I mean, it's not doing the same thing it did from 2020 to 2022. It's not going exponentially higher. So if you bought and then your neighbor sells, the next day for, $20,000 lower, you are now underwater technically. So
I love this question. Paul, what a great question. Is there a similar chart for Manhattan? We don't have a similar chart for Manhattan, unfortunately.
We should make that.
We should make
that chart.
But you'd have to, I don't even know how you would come up with a methodology for it, but I mean, you would have to come up with some type of current valuation for each unit, I guess. But I mean, you can somehow figure it out. But no, we don't have a chart for Manhattan. It would be, what would it be? I mean, Manhattan hasn't done anything in a decade in terms of price action. Could be like quadruple that number. Could be 6 times that number.
I don't know.
Could be 40, 50%. That's crazy.
It'd be if you guys have ideas on how to put that chart together, I would love to hear it because it's a cool chart. I think we did something back in late 2020, I think, about how many people were reselling and if they're higher than the resale or lower. I think Brown Harris has put out a piece very similar to that. So there definitely are methodologies out there. A lot of it relies
like
on
repeat sales,
sale,
repeat units.
but sometimes it's tricky because maybe they renovated, right? And then they add some value that way.
Yes.
So it's always kind of tricky.
Maybe there was assessments. Maybe there was construction nearby the area. Maybe there's some local thing that's the local force. But it's hard.
We are gluttons for data punishment. So if you have an idea, send it to us. John at UrbanDigs, Noah at UrbanDigs, and we'll see if we can dig into it.
It's pronounced gluten.
Yeah, Noah's gluten free.
No, I am not.
I'm a glutton.
I gluten it up. Existing home sales. This is, Compass has a new chief economist. Mike Samuelson, I think is his name. Sorry if I got it wrong, Mike. I think that's his name. Existing home sales. He put this out, and he's basically talking about. Take a look at where we are. Can I draw over this? Yeah, I can. Here's where we are. Basically, and you can see that the 2025 high over here. Oh, excuse me. Sorry, we're over here. 2025 high, 2025 low. We're doing better than last year. This is a story that's going on not only in our market. I feel like our market's picked up over the last 60, 80 days, kind of a thing. Since like the beginning of fall. Started slow, started getting better. I don't know if you guys are experiencing this. The pickup in the I see the data. It shows it.
Yeah, the data shows it.
Yeah, I'm seeing that across the nation. Like when I look outside of our bubble and I look at the national housing market, I'm also seeing a pickup. I'm seeing a little bit of pickup in mortgage applications, stuff like that. Very noisy, very weekly, but okay. But like the national housing market is picking up from such a low depressed level that none of this really means too much to me until it starts to make a major move. So yes, things are picking up, but it's like it's been in the gutters for a long time. The national housing market's been going down for years.
Yeah, well, I think the idea is that this is a green shoot, right? It's been brown shoots. Like, oh, look at these leaves. I got to cut them off because the plant's going to die, kind of thing. So it's just like getting rid of those brown leaves, starting to see some green leaves. Hopefully, it turns into a lovely flower.
Yeah. So I want to show you that. I thought it was interesting. All right, so that's it. Let's go. Let's circle back to Manhattan. Back to Manhattan real estate. This is Manhattan, guys. We talked about this on Friday. All right, strategizing for the upcoming seasonal shift. What you're looking at here is, let me just try to explain. If you, I can't draw on this one. Damn it, they contain Simon. If you take November contract activity, if you take November contract activity and divide it between the first half, November 1st and November 15th, first half, and then November 15th to November 30th, second half, okay? And you divide those up, the second half is on average 13% lower than the first half. This is stuff that we know, but we did this for a reason because we're getting asked all these questions from agents. My seller wants to make a price cut in 2 weeks after Thanksgiving. I got a seller that's looking to come on right after Thanksgiving. And I try to explain to them that the second half of November is always down. So this was like a few days ago, we did this. We're at a good level right now. That's the thesis. We're at a good level right now with deal activity. We're kind of at our peak level. We're starting to slow already. This process that you see here, this down 13% is already in play. So take advantage of it as you can with the peak activity that was going on about 5-6 days ago in the market. That was the point of it.
Well, first of all, not always. I mean, I don't know what happened in 2016. I want to give that was a new dev. Remember we had all the new dev issues, which is just you'd have these dumps of new dev contract signs. It was never listed. Just like, hey, here's another 200 units we signed into contract this month. Fantastic.
Yeah. Off market stuff.
Yeah. That could be affecting things. But the other thing that's really interesting, and I'm thinking about ways to again, lash myself with data. And the idea is that when you look at the trend in these things, right, you look at the very beginning, right? 2008, or was it 5, 6, 7?
5.
See how they're getting progressively worse, right? We're sort of headed into kind of like a environment. And then you look at, say, 9, 10, 11, they're starting to get a little bit better. And then we kind of rallied in. So it's like when the tail end of November gets better, it's kind of maybe suggests that we might start seeing an improvement in overall market dynamics and maybe sort of a rally into the spring. So we're kind of right now we've had, you look at 23, 24, and now 25, it's been improving back half of November. So I'm hoping that this does, look, all things being equal, let's keep all things equal as long as we can. I think this is actually setting us up for hopefully a very productive spring. Brooklyn, on the other hand.
Well, here's Brooklyn.
Yeah.
Here's Brooklyn. Much different. But yeah, the average around 14%, but the last couple of years is different. I feel like we're heading into the next year we're not going to have, most likely not going to have this tariff and all that stuff, uncertainty that hit us this year, especially with April and disrupted our whole market. We're already past the election. I think the uncertainty and doubt, well, it may still be on there, and people are making moves, I'm sure, but you have a lot of people that are delaying and pausing because of uncertainty. That will go down. So you have elements, macro uncertainty elements that I don't think are going to be there in April. It's just stuff that we're going to have to, like, what's going to happen that we're unaware of. What's the unknown, right? We don't know of what may happen. That's what I'm worried about in April is rates not going to get cut as much. Is the stock market going to have a correction? I'm always worrying about that kind of stuff, by the way. So that's not,
look, New York City's going to have a new mayor in a month and a half. So it's like you have all these things sort of, on the playing field, which is, how's that new playing field team going to bat? I'm just mixing analogies together. I do want to address a question. Thank you for putting that up. Bring on a 3-bedroom, 2-bath to the market. Put it on sooner. Wait until New Year. They need to sell but don't want to be killed. I would argue that most sellers need to sell but don't want to be killed. That is, a universal seller emotion. It's a tricky one though, because this time of year is not ideal for bringing a listing onto the market. But I would tell you this. I know it's got optimal time to list. I would look at something else. I would look at discounted days on market. I would look at discounted days on market. And what I would say is, if it's priced right, it's going to move regardless of the market. Like good market, bad market. If you priced right, you're going to sell pretty much at your asking price. The key is getting that asking price just absolutely right. So if you bring something to market now, you better be sure that asking price is exactly where buyers are expecting.
Sell in 2-3 weeks. Yeah.
But
and just Thanksgiving, no.
Get it moved.
So it's a tough if they need to sell. See, you had me to that last part that they need to sell. I was originally going to say try to wait till February, like late February or March, if you can, to take advantage of this period of time, which is most contract activity period. That's the top 4 months. 1, 2, 3, 4, top 4 months of the calendar year. We have this right now, but we're at the very end of it. So John's right. If you're going to put it on now. And let me show you the discounted days on market chart that John was referring to. It's all the way. Where is it? Where's my here? Discounted days on market. Yeah. And what John's basically saying is, all right, let me try to explain this chart, guys. You want to look at the right side here. Look at this. Okay. Look at this. Okay. Now, this right here, what we did is we looked at all the closings, sold, verified closings. And if you got a signed contract in less than 30 days, what is your listing discount? 0. So this 30 days, just to do it this way, like delete this. This 30 days aligns to that 0. What if you got a contract 31 to 60 days? 2% listing discount. 61 to 90, 5%, et cetera, et cetera. If you price it right, you should sell it quickly and not have to negotiate. So if you're going to put it on the market now against seasonality, which of course you're going to tell them, you have to tell them that this is not the time to list, but here's my thinking, right? If you put it on now against seasonality, your only hope is that you do not test the market, that they're not aspirational, that you are very confident with your comps report and your analyses on pricing, where this should be, and you price it at or below that level and let the market do its thing.
Yeah, I would agree.
Otherwise, you're going to be on the market for months.
At some point, we even had a chart. Maybe we should refresh this. We looked at what that daily decay of your asking price is going to be. So, forget about 30-day, 60-day buckets. Like, what about day 10 versus day 15? What does that look like? And basically, it takes this chart and breaks up, and you can see there's just a very, very gradual. We looked at all the data. It's just a very, very gradual, pretty much a linear slope from asking price of 100% all the way down to like asking, getting 88% of your asking price the longer you're on the market. So like every day does matter. So you really, really, really want to price it right, pretty much regardless of markets. And if it's one of these markets where, you think back to that crazy spike in 2016, you think about a market like that where you throw something on the market's absolutely starved for supply. Something comes on, you're flooded with buyers, bids come in over the ask because people just have to have it. Yeah, in that sort of market, you could put it on and not necessarily worry about price because there's enough of that competition froth to grab it. We're not in that market. Price is still very crucial, so it's absolutely has to be priced right, but it's still doable, totally doable.
Yeah. And Carol asked, what is the diminishing return if they keep it, if they already moved out, they don't want to hold it, they need to sell quickly? And I imagine they just need to sell it. There are people that need to sell it. So I think that's really good advice, John. Really good advice. And I think those are really two good charts. Really two good charts. You could also use the pricing penalty chart, which is another variation of that discount to days on market. It just breaks it down between 60 days or less and 120 days on more, but it shows the exact same thing. If you sell in 60 days, you're going to only negotiate 1%. If you're on the market 4 months or more, that penalty is 11%. It's pretty persuasive for telling someone you have to price this right, otherwise we're screwed. It messes my whole strategy up because now you're in December, January, February. You're going to be on the market for 4+ months, 4.5, 5 months going into the next active season.
Right. If you have a 6-month exclusive, right? Let's just talk about nuts and bolts from what really matters. If you have a 6-month exclusive, starts in mid-November, ends in mid-May, and then someone else takes it over because it doesn't sell, great. They've got it just in time for the tail end of the spring season, which is like,
you don't want to do that. You don't want to do
that.
Nah, you don't do that. All right. Excellent. I hope this pain versus pleasure conversation. Absolutely.
Exactly.
All right. Be confident. Tell them what it is. Blame us. Blame UrbanDigs. Blame the bull guy at UrbanDigs. All right. It's not your fault. This is what the market is. You're strategizing. I think we're done. I think we're done, guys. We're past time already. It's Thanksgiving. I want to take a moment to wish all you guys a very happy and safe. If you're traveling, safe travels. Happy Thanksgiving. Eat well, drink well, be merry. Right, John? I'm thankful for you. I'm thankful for you guys. I love what I do over here.
Yeah, I'm thankful for the New York City brokerage community is an amazing community.
Love it.
It has people from all walks of life, have all kinds of backgrounds, and the conversations are really amazing. They start at one place, go to another. It's a terrific group of people. So thank you all very much for being part of our audience. It really does make this a really fun job.
It means a lot.
Before I go, there's a quick question. Noah, thank you for sharing the discount to days on market chart. Where can we download this?
Okay, so you go to chart room. Okay, chart room on the left. Okay, just learn this. These are all my charts. You go to discount to days on market. There's a lot of charts. Click on discount to days on market, localize it to your neighborhood and your prop type and all that kind of good stuff. And every single chart, will have a download button and a share button. You can either just copy the URL or just download this in any specific format for social media or images. You could download the data in Excel file and then do your own chart and present it in your own way, or you can export it as a PDF. So these are the 2 buttons for every single chart. Okay. If you ever have a problem, John at UrbanDigs, he's right there. Can't wait to talk.
That's true. Happy.
Okay. Awesome.
Thanks,
Happy Thanksgiving, guys. Thank you, John Walkup. I am Noah Rosenblatt. We are both with UrbanDigs. It's been Macro Monday. Catch you next time. Cheers, everyone.
Happy Thanksgiving.